Call it the battle of the brains on Wall Street. Hedge fund managers who beat their peers last year are betting that the recession isn't over. That pits them against top economists and policy managers who say the recovery is underway. Only one side can be right. Bloomberg's Sue Keenan has the latest.
Everybody loves a battle, Scarlett. It also means that some of the smartest people on Wall Street are about to be wrong. Now, here's the divide. On the bearish side, you have a group of hedge fund managers who oversee about $17 billion and outperformed their rivals last year. The group includes London's Horseman Capital with just over $4 billion under management, and as with the other funds, a macroeconomic strategy. Tudor Investment, the Connecticut-based $10.8 billion fund, founded by billionaire Paul Tudor Jones, and Clarium Capital, with just about $2 billion under management, where one managing director says, quote, if we have a recovery at all, it isn't sustainable. Now, Kevin Harrington calls this a ski jump recession, with short-term stimulus creating a bump, he says, that will ultimately lead to a more precipitous decline later. He's bearish on stocks and long the U.S. dollar. And get this, the bearish bets of all these big funds, even as stocks and bonds have risen, may have prevented other macro funds from rallying with the market. Global funds were among the worst performers in July. Now, in the bullish camp are the economists. At least 53 surveyed by Bloomberg predict the U.S. will grow 2% in each of the next 4 quarters. That's the healthiest growth streak in 4 years. Goldman Sachs' Abby Joseph Cohen puts it this way, quote, we think the recession is ending right now.
Now, Sue, Abby Joseph Cohen, of course, a perma bull. Let's focus on the bears a little bit here. Why do they think they're right when the market appears to be saying that they're wrong?
Which is a tough position to take, by the way. Their view is this: focusing on misleading indicators of U.S. economic activity rather than the more accurate measures of growth is driving the gain in asset values. An example is focusing on the unemployment numbers as opposed to a lesser-known gauge of people who've been out of work so long they're now taking temporary employment. Now, some warn of significant headwinds as stimulus spending fades after the current quarter, and they say the root of the banking crisis has not been addressed. Banks, they say, still hold toxic assets on their balance sheets. Scarlett?
Thanks so much, Sue.